You check your phone again. Bitcoin just dropped 15%. In an hour, your stomach churns. You thought cryptocurrency was supposed to be your ticket out of the 9-to-5 grind, away from the system that keeps you living paycheck to paycheck. But here you are, watching your investment evaporate while somewhere, someone in a glass tower is making money off your panic. You feel it in your gut. The game is rigged. But you can't quite see how. I am Jason. And I've spent years studying how money really works, not the fairy tales they teach in school or the hype you see. On social media, I've become obsessed with uncovering the patterns that keep ordinary people stuck, while others seem to effortlessly build wealth. If you are interested in understanding the real rules of money, so you can finally get ahead, please don't forget to subscribe. And hit that like button. I share insights that most financial advisors won't tell you because honestly, they benefit from you not knowing. Let me introduce you to a concept I call financial asymmetry exploitation. It sounds complicated, but stay with me because understanding this will change how you see every financial decision you make. Financial asymmetry exploitation happens when institutions use their superior access to information, capital, and regulatory advantages to profit from the predictable behavior of regular investors. In simple terms, it is like playing poker when everyone else can see your cards, but you can't see theirs. Banks and large financial institutions don't just participate in markets, they shape them, and they've found ways to do this even in spaces that were supposed to be outside their control. Like cryptocurrency, the core value here is recognizing that you are not losing money because you are bad at investing. You are losing because you are playing a game where the rules are written by people betting against you. Once you understand this, you can stop making decisions that feed their profits and start building real, sustainable wealth. Let me show you exactly how this works in real life. Take Sarah, a marketing manager making $58,000 a year. She has got $12,000 in savings, and she is terrified it is losing value to inflation. She sees Bitcoin surge and thinks this is her chance. She puts $8,000 into crypto through a popular trading app. What Sarah doesn't know is that when Bitcoin's price starts moving dramatically, it is often because large institutions are executing massive trades that trigger automated selling from millions of small investors like her. In 2021, a single entity moving $2 billion in Bitcoin could trigger a 5 to 8% price swing within minutes. Sarah sees the price dropping, panics, and sells at a loss. The institution buys back at the lower price. Sarah just transferred her wealth upward, and she has no idea it was orchestrated. Now compare that to Marcus, who makes about the same as Sarah but takes a different approach. Instead of chasing Bitcoin, Marcus puts that same $8,000 into a boring index fund that tracks the total stock market. Over 10 years, historically, that investment would grow to roughly $18,000, assuming a 7% average annual return. Not exciting, not sexy, but Marcus still has his money plus gains. Meanwhile, Sarah, who tried this pattern 3 times over 2 years, turned her $12,000 in savings into $4,000. The difference isn't intelligence or luck, it is understanding. That volatility benefits whoever has the most information and capital. And that is never going to be you. Here is another example that hits closer to home. Think about how banks promote cryptocurrency trading now. Chase, Bank of America, and others have started allowing crypto purchases through their platforms. They market it as democratizing finance, giving you access to the future. But here is what they don't advertise. When you buy crypto through a traditional bank platform, you typically pay a spread. The difference between the buy and sell price. That can range from 1 to 3%. That means the moment you buy, you are already down up to 3%. If you invest $5,000, you are starting $150 in the hole. Now add the fact that these same banks often restrict when you can move your crypto, essentially trapping your assets during volatile periods. In May 2021, when Bitcoin crashed 30% in a single day, multiple platforms, including Coinbase and Robinhood, experienced convenient outages that prevented users from selling. Institutions with direct market access had no such problems. They could exit or buy the dip while retail investors were locked in, watching their portfolios bleed. The pattern repeats across every financial product marketed to regular people. Credit cards with rewards programs that require you to spend $30,000 annually to earn $500 in benefits. Which sounds great until you realize that people who chase those rewards spend an average of 23% more than they would without the card. That is an extra $6,900 in spending to earn $500 back. The asymmetry is baked into the design. Or consider mortgage refinancing offers that promise to lower your monthly payment by $200. But extend your loan term by 7 years, ultimately costing you $48,000 more in interest. The bank wins, you lose, and it was marketed as doing you a favor. Now I know what you are thinking. First, objection. Jason, I don't have enough money for this to matter. If I am only working with small amounts, these games don't affect me. Wrong. The asymmetry exploitation hits hardest when you have the least. When you've got $200 and you make a bad financial move, losing 20% means you've lost $40, which might be your grocery buffer for the week. When someone with $2 million loses 20%, they're still a millionaire. The pain is not proportional. Plus, the fees and spreads are often flat or percentage based in ways that hurt smaller investors more. That 3% crypto spread costs you more proportionally because you can't negotiate it down and you don't have other income streams to absorb the loss. Second objection. But Jason, if I don't invest in things like crypto or stocks, inflation will destroy my savings anyway. I have to do something. You are absolutely right that you need to do something. But the solution isn't jumping into whatever investment is being advertised. To you, inflation in the U.S. has averaged around 3% annually over the past 30 years. If you chase volatile investments to beat inflation and you lose 15% in a panic sell, you've just experienced 5 years of inflation damage in a single day. The math doesn't work. What does work is building a foundation that doesn't require you to outsmart institutions with billion-dollar algorithms and insider access. Here is what you can actually do, starting today, to stop feeding the asymmetry machine and start building real wealth. First, establish a true emergency fund before you invest a single dollar in anything volatile. I am talking about 3 to 6 months of expenses in a high-yield savings account right now. Some online banks offer savings accounts with 4 to 5% interest. That is not going to make you rich, but it means your safety net actually keeps pace with inflation while remaining accessible. If you are making $45,000 a year and your monthly expenses are $3,000, you need $9,000 to $18,000 in this fund. Yes, that sounds like a lot, but this is your defense against forced bad decisions. When Bitcoin crashes and you don't have emergency savings, you might have to sell at the worst time to cover an unexpected car repair. With proper savings, you can ride out volatility, or better yet, avoid it entirely. Second, automate your wealth building in ways that remove emotion from the equation. Set up automatic transfers on the day you get paid, before you see the money, into low-cost index funds. I am talking about funds with expense ratios below 0.1%, like total market index funds. If you automatically invest $300 per month starting at age 30, assuming a 7% average return, you'll have over $360,000 by age 60. That is not including any raises or increased contributions. The key is that you are not trying to time the market or pick winners. You are buying everything, consistently, which historically has always recovered from downturns. Institutions can't exploit your panic selling if you never sell. Third, completely avoid any investment product that is being heavily advertised to you. This is a hard rule. If you are seeing ads for it on social media, if there is a celebrity endorsement, if it promises quick returns, walk away. Marketing costs money, and that money comes from somewhere, usually your pocket through fees, spreads, or designed in losses. The best investment vehicles are boring and cheap. Nobody's making Super Bowl commercials for Vanguard Total Stock Market Index Fund because the profit margins are too thin. That is exactly why you want it. Fourth, educate yourself on the fee structures of everything you use financially. Look at your bank statements and identify every fee you paid last month. Overdraft fees, ATM fees, account maintenance fees, wire transfer fees. Add them up. The average American pays roughly $329 per year in banking fees alone. That is money you are handing to institutions for basically nothing. Switch to banks and credit unions that don't charge these fees. They exist. They're FDIC insured, and they're often more user-friendly. That $329 invested annually at 7% for 30 years becomes over $30,000. You are literally giving away a new car every few decades in unnecessary fees. Fifth, create a personal investment policy statement. This sounds formal, but it is just a one-page document where you write down your rules. Mine says things like, I will not invest in anything I don't understand. Well enough to explain to a teenager, I will not check my investment accounts more than once per quarter. I will not sell investments based on news headlines or price drops less than 20%. I will not invest money I might need within 5 years into the stock market. Having this written down means when Bitcoin is surging or crashing, when your coworker is bragging about their gains, when fear or greed kicks in, you have a predetermined response. You've already made the decision in a rational moment, so your emotional moment can't sabotage you. Here is the truth that nobody wants to tell you. Financial freedom doesn't come from finding the secret investment or catching the right trend. It comes from consistently doing boring things that compound over time while avoiding the traps specifically designed to separate you from your money. Banks and institutions have found loopholes in everything, including Bitcoin, not because they're evil geniuses but because the system is built to reward people who already have resources and information advantages. You can't beat them at their own game, but you can refuse to play it. Every time you resist the urge to chase a hot investment, every time you choose the boring index fund over the exciting crypto, every time you keep your emergency fund intact instead of YOLOing to whatever's trending, you are keeping your wealth instead of transferring it upward. Over a lifetime, these decisions are worth hundreds of thousands of dollars. That is not an exaggeration. That is just math. The financial system counts on you not knowing these patterns. It counts on you feeling desperate enough to take big risks, uninformed enough to pay unnecessary fees, and emotional enough to buy high and sell low. The moment you understand the asymmetry, you can step out of it. You won't get rich quick, but you also won't stay poor. You'll build steady, real wealth that nobody can manipulate away from you. If this perspective helped you see your finances differently, do me a favor. Smash that like button and subscribe, because I am going to keep breaking down the patterns they don't want you to see. Share this with someone who is stressed about money, who has been burned by investments they didn't understand, or who is just tired of feeling like they're running in place financially. The system stays rigged only as long as we don't understand how it works. Once you see it, you can't unsee it. And that is when everything changes. You've got this, and you are not alone in figuring it out.